In response to popular demand, here's an insight into my trade idea generation process. Before we get into it, this is not financial advice, this is purely for your educational basis. Do read the disclaimer, and for the love of God, don't put on this trade. The company we're looking at today is PTLO. It's a US-based restaurant operator listed on the Nasdaq. It was trading at around 22.36 cents last night, with a market cap of around 1.6 billion. So I believe there's significant downside potential for this stock price, and I'll try to explain why. The first thing that we normally look at are the expectations. So what's baked into the price? What is the market? In other words, analysts, investors, traders thinking about the company from a fundamental perspective. Mainly what we're talking of is revenue growth and earnings growth potential. So being a small company, one would expect it to have a pretty high revenue growth potential. But what's more interesting here is the earnings potential that the market assigns to this company. I think it's pretty lofty when you look at 2024 and 2025. The next step is to do a bit of a quantitative analysis and also looking at the company with respect to their peers in the industry. But I'm going to try to summarize the whole process for you. So you have a company here that makes annual revenues of $610 million, but only yields a net income of 10 million. And the market is willing to buy and sell this company at a forward PE of 58 times. So for anyone that's familiar with the market and how it works, 58 times forward PE is normally assigned to a company that's able to grow revenue and earnings pretty steeply. The catalyst for this trade, as we've spoken about, it's the stretch valuations. I also believe that the consumer spending slowdown that's coming into the future would be putting brakes on revenue growth potential of this company. Um, in line with that thinking, I think the cost of debt is also rising in the US in line with the interest rates. So for this company, it's becoming a lot more expensive to get debt. And why is that relevant? It's relevant for two reasons. The more debt becomes expensive, the more that hits the bottom line. So the earnings potential of the company reduces. And secondly, as we've seen, this company, the market expects pretty high revenue and earnings growth. And this would predominantly come through setting up new stores. For anyone in business, you would know that if you need to open new stores, you need to put up capital, and the capital normally is funded by debt. So if debt is becoming more expensive and maybe less available, then that would really challenge the expectations that the market have in the future for this company. Um, at the same time, this is evidenced by them having recently gotten a new loan at around 8%, which is a pretty steep increase with respect to how cheaply they were able to get debt in the past. I also believe that we can have a significant increase in volatility in the next few months, which would lead to a sell-off in high beta stocks and mid-cap stocks. This is a highly contrarian view, this whole trade, very, very contrarian, because if you look at the restaurant numbers, the restaurant industry numbers in Q2, companies that have been reporting in the past few weeks, the numbers have been pretty good on both revenue growth and earnings growth. Uh, and more predominantly, we've seen that companies have really benefited from food cost inflation coming down. So margins have improved. At the same time, it's a pretty busy quarter in the US because it's the holiday season, so people are out there traveling and going out for the summer. So it's pretty good quarter for the restaurant industry. But I think there's still some merits to the trade here. Um, so it's currently trading at 22.36, and I believe we could get to 15. That's my price target. Of course, it doesn't just come as a random number that I'm just putting out there. It's coming out from the process in terms of understanding how the market might look at this company after earnings, which happens to be today. Um, would the market assign a lower multiple to this company if they figure out that it's not growing as quickly as it was anticipated. Um, will the market give it a multiple? It's currently 58. Would the market give it a multiple of 70, 90, 100? It's quite unlikely. Would the market maybe look at it and say maybe 40 is a better multiple, 30, 20? I think that's probably more reasonable. So to capture this opportunity of the stock moving from 22.3 to 15, I've bought puts that expire in September 15th, 2023, with a strike price of 20. So one contract costs around 45 cents. At the price target, if we hit that, I think the puts would be worth around $5, which gives us a potential profit of 1100. What's more interesting here is we also have to think of this trade in the context of the portfolio. So this is another concept that is separate from trade idea generation. But I think it's worth mentioning that because if the market really doesn't like the earnings and there are significant tailwinds for this company in terms of being able to achieve revenue growth and earnings growth, then who's to say that this just doesn't get chopped in two, right? We could go to 10, 11, and at 10, 11, you're probably getting 20, 25 times your money instead of 11. So this is really a tail risk trade. And you normally try to put these types of trades into the portfolio, and that in itself can help you a lot when you have a sell-off in the stock market. Let's say if we go into a recession, of course the market is not going to give this company a 58 times multiple in a recession. So you really have to think about the trade idea, but also put it into context with what's in your portfolio and how you're structuring risk, trading in and out risk into the portfolio. In terms of my trading plan, I've got a plan in terms of multiple scenarios that could happen after earnings today. So I'm going to go through the figures, the earnings call, and understand what's the fundamental picture of the company and see whether I need to restructure my trade. As we speak, the company has reported earnings a few hours earlier. It's missed earnings. Last time I looked, the stock was down 10%. So this is kind of getting out there, and the market is now slowly realizing that they've probably given lofty valuations to this company. As with every trade, we need to understand what are the risks to the thesis. One of the biggest risks is that the market just dismisses the stretch valuations. One could argue that for months, the market was happy to trade millions of dollars of this stock at 58 times the valuation. So who are you to actually say that 58 is the wrong multiple to give to this company? The market could still continue to give 58 or even higher multiples to this stock. As we've spoken, there is a risk that margins of this business improve thanks to a reduction in the food cost inflation. So this would increase the earnings, and the market would look at the fundamental picture for the company a lot more differently if earnings were to come out more strongly. We can also have much higher revenue growth than anticipated. We've seen quite strong numbers from the restaurant industry in the US in the last few weeks, hence why I say this is highly contrarian. But looking at earnings, just scanning through the numbers, it seems that the thesis is working. But at the time I put up this presentation, I did not have the benefit of seeing the earnings numbers. So as part of the process, the trade idea generation process, you don't have information to look at in hindsight, right? There's another risk that the analysts just upgrade the stock. So Morgan Stanley was one of the underwriters on the stock, and it's now covering it. And in my view, I think they are dishing out lofty price targets. There's also a risk of a short squeeze. So all the technical traders out there will understand what I mean. So this is basically where traders who have sold the share of the company, anticipating that the numbers will not be great and so on, they are forced to buy back their shares because maybe the stock price is going up, the thesis is not working, and something of that nature. So that creates sustained buying pressure on the stock, which will cause the price to go up. In this case, the short interest is around 13%, which is maybe it's not high, but it's a bit too high for my liking. And that in other words means all the people who are short the stock will take around 8 days for them to be able to cover their positions, so to buy back all their positions. So that could create significant upside pressure for the stock price over my trade horizon. So this is it, guys. I hope this was useful. Do let me know if you like what you've seen. Of course, it's a much shortened version of what actually goes behind the scenes. But I'm just showcasing the process and just hoping that this will help you to understand a little bit of what happens in financial markets and why stock prices move up and down and so on and so forth. Thanks very much.